Let me paint you a picture. You apply for a credit card. You fill out the form, you wait the usual few days, maybe a week, and then the email arrives. Approved. You feel that small rush, right? That little sense of relief or maybe even validation. You open it up, and there it is, your credit limit. And then you pause, because the number feels oddly specific. Not a round number you might have hoped for, not what your friend got on the same card. Just this precise, seemingly arbitrary figure staring back at you. And you wonder, how did they come up with this? Did someone actually sit down and think about me? Did a human look at my life, my income, my spending, my history, and decide that this particular number was what I deserved? The answer is both more mechanical and more personal than you think. And understanding it, really understanding how this works, changes the way you relate to credit forever. Not because it's some cheat code or hack, but because when you understand how a system sees you, you stop feeling like the system is something that just happens to you. Most people think about credit limits the way they think about grades in school. You're either good enough or you're not. You either pass or you fail. And if you got a low limit, some part of you feels like you got marked down, like the bank looked at your life and quietly said, "Not quite." That framing is understandable. But it's also kind of wrong, and I think it keeps a lot of people stuck. Because the bank isn't judging you. I know that sounds almost impossible to believe, especially if you've ever been denied or given a limit so low it felt insulting. But the bank is not sitting there with a moral opinion about your character. It's running a calculation, a cold, systematic, data-driven calculation, and the inputs to that calculation are more nuanced than most people realize. Here's what most people think determines their credit limit. Their credit score. Full stop. They think it's basically a number in, number out system. High score, high limit. Low score, low limit. And while your credit score ladders, it absolutely does, treating it as the only variable is a bit like thinking your doctor only looks at your weight to assess your health. It's one signal among many. And the rest of those signals? Most people have no idea they're even being read. What I want to do in this video is take you behind the curtain, not in a scary, conspiratorial way, just honestly. Because when you understand how this system works, it stops feeling arbitrary. And that's actually a relief. So let's start at the beginning. When you apply for a credit card or a loan, what exactly is happening on the other side? There's a concept in banking called a risk model, and it's exactly what it sounds like. A model designed to measure how risky it is to lend you money. The bank's fundamental question is not, does this person deserve credit? The question is, if we give this person access to money, what's the probability that we get it back, on time, with interest? That's it. That's the whole thing. Every piece of data they collect about you is in service of answering that one question. Now, these models are built by teams of data scientists and statisticians who study millions of accounts over years. They look at people who defaulted on loans, people who paid perfectly, people who carried balances, people who paid in full every month, and they find patterns, statistical patterns that predict future behavior. And those patterns get baked into an algorithm that processes your application in a matter of seconds. So when your application goes in, it doesn't go to a human first. It goes to the algorithm, and the algorithm spits out a number, your credit limit, based on how you score across a range of factors. Let's talk about what those factors actually are. The first one is your income, but not in the way you think. When you write down your income on a credit application, the bank doesn't just nod and say, "Great, moving on." They look at that income in relation to your existing debt. There's a concept called your debt-to-income ratio, which is essentially a way of measuring how stretched you already are. If you make $40,000 a year but you're already paying off a car loan, a student loan, and a personal loan, your available bandwidth for new debt is narrower than someone making the same income with no existing obligations. And here's where it gets interesting. The bank doesn't just look at what you tell them, they look at your credit report, which shows them all your active accounts, your current balances, and your minimum payment obligations. So even if you're financially managing everything fine on paper, if you have a lot of open accounts with balances, the algorithm registers that as existing load, as used capacity. Your credit limit, then, is partly a function of what the bank believes you can reasonably absorb. They don't want to give you a limit so high that you max it out and then can't pay it, because that's bad for them, and actually that's also bad for you, even though in the moment a higher limit feels like a better deal. The second factor is your credit utilization history. This one is subtle but really important. Utilization is the ratio of how much credit you're using compared to how much you have available. If you have a card with a $10,000 limit and you regularly carry a $4,000 balance, your utilization on that card is 40%. Banks watch this pattern very carefully, not just what your current utilization is, but how it's moved over time. Have you been consistently maxing out cards? Do you spike right before payments and then pay it down? Are you someone who uses credit for everyday purchases and pays in full, or someone who leans on it when things get tight? These behavioral patterns tell the bank something about your relationship with credit. Someone who keeps utilization low and consistent is signaling to the model that they have financial breathing room, that they're not borrowing out of desperation, but out of convenience or strategy. That's a lower risk profile, and lower risk generally means higher limit offers. The third factor is your payment history, but the nuance matters. Yes, paying on time is critical. That's not new information. But it's not just about whether you paid, it's about how you paid, what you paid, and when. Someone who makes the minimum payment every month, never misses a payment, technically has a clean record. But the bank sees the pattern. They see that this person is carrying revolving debt, not paying it down, and paying the minimum, which tells them something about cash flow. Not that you're irresponsible, but that you might be operating with tighter margins. Compare that to someone who pays their full balance most months, occasionally carries a small balance and has never missed a payment. The bank sees a different pattern entirely. Same clean record, but a meaningfully different financial picture. The fourth factor is the age and diversity of your credit history. This one surprises people. It's not just about how long you've had credit, it's about what kind of credit you've had. Banks like to see what they call credit mix. Have you successfully managed different types of credit? A credit card is one thing, but if you've also had an auto loan or a mortgage or a student loan and managed them responsibly, that tells the bank you can handle different structures of debt, different repayment rhythms, different amounts. It's a bit like a hiring manager who feels more confident about a candidate who's worked in different environments rather than just one. Variety of experience suggests adaptability. The age of your accounts matters too, because it gives the model more data to work with. A long credit history, even an imperfect one, often works in your favor simply because there's more behavioral data to analyze. A short history, even a perfect one, leaves the model with limited information, which means more uncertainty, which means the bank hedges by offering a lower limit. The fifth factor is something most people have never heard of: your spending velocity. If you have existing credit accounts with the bank, or sometimes even with other banks through data sharing agreements, the model can look at how you spend, not just how much, but how fast, in what categories, and whether that behavior has changed recently. Someone who has been spending steadily and predictably for years is easier to model, but someone whose spending suddenly jumps, maybe they started a business, maybe they had a life event, maybe they're going through financial stress, that volatility registers as uncertainty in the model, and uncertainty in a risk model almost always means caution. Think about it from the bank's perspective. They're trying to predict your behavior 6 months, 12 months, 2 years from now. Consistency is a form of predictability. Predictability, to a lender, is a form of safety. And then there's a sixth factor that almost nobody talks about: your relationship with the bank itself. If you're applying for a credit card at a bank where you already have a checking or savings account, the bank has something valuable that no credit bureau can give them: actual transaction data. They can see how much money comes in each month. They can see whether you maintain a positive balance, whether you overdraft, whether there are periods where your account runs very low. This internal data is powerful because it's real. It's not what you told them, it's what's actually happening in your financial life. Banks that have this kind of relationship data will use it to calibrate their risk model in ways that can work either for you or against you. If you keep a healthy average balance, rarely overdraft, and have consistent income deposits, the bank has reason to trust you more than the credit bureau data alone might suggest. But if your account regularly dips near zero, if you have a pattern of overdrafts, if your income deposits are irregular, that tells its own story, independent of your credit score. Now, here's where I want to take a step back and talk about something that doesn't get discussed enough. These models are sophisticated. They're also imperfect. And in some cases, they encode the very inequalities that people experience in the real world. If you grew up in a household that didn't use traditional banking, you likely have a thin credit file. Not because you're irresponsible, but because the systems that build credit history were never fully accessible to your community. If you've had periods of financial instability, a job loss, a medical emergency, a divorce, those events leave marks in the model that last for years, long after you've recovered. If you're early in your career, your income looks small to the algorithm even if your trajectory is strong. The credit system is a mirror, but it's a slightly distorted one. It reflects your financial past more than your financial future, and for a lot of people, those two things look very different. I'm not saying this to be cynical. I'm saying it because understanding the limitation of the system helps you work within it more strategically and helps you stop internalizing the score as a verdict on your character. It isn't. Let me also talk for a moment about what happens after you get your initial limit, because the limit isn't fixed forever, and the ongoing process of how it changes is just as interesting. Banks continuously reevaluate your account. It's not just a one-time decision. Every few months, their models run what's called a behavioral scoring update on your account. They're looking at how you've used the credit they gave you, whether your behavior matched their predictions, and whether your risk profile has improved or deteriorated. If you've had a card for a year, consistently kept utilization moderate, paid on time, and the rest of your financial picture looks stable, many banks will proactively increase your limit. Sometimes they'll notify you, sometimes they'll just quietly raise it and mention it in a statement. If you call and ask for an increase, the bank essentially runs a new evaluation. They'll look at whether anything has changed, income, credit score, utilization, payment history, and make a fresh calculation. A hard inquiry sometimes happens here, sometimes not, depending on the bank and the size of the increase. What's worth knowing is that simply asking, if you've been a responsible account holder, often works. Not because the bank is doing you a favor, but because the updated data suggests they can safely extend more credit. And more credit available to you means more potential revenue for them through interest and fees. It's mutually beneficial, which is why banks aren't opposed to raising limits for customers who've earned it. Here's the mindset shift I want you to sit with. Most people think about credit passively. They have it, they use it, they worry about it sometimes, and they kind of hope the score goes up. But they don't think about themselves as being in a dialogue with the system, a dynamic, ongoing conversation where your behavior sends signals and the system responds. That shift from thinking of credit as something that happens to you to thinking of it as a system that reads you changes everything. Because once you see it that way, you start to realize that you have more influence over your credit profile than you probably thought. Not through tricks or loopholes, not by gaming the system in some dramatic way, but simply by understanding what signals the system is reading and being intentional about what you're sending. Think about it like this. If you knew that a hiring manager was going to look at your LinkedIn profile before your interview, you'd probably make sure it was up to date and represented you accurately. You wouldn't see that as fake or manipulative. You'd see it as basic self-awareness, making sure the picture of you that exists in a system accurately reflects who you actually are. Credit works the same way. If your credit utilization is high right now, not because you're in financial trouble, but because you had a big month of expenses, knowing that the bank reads high utilization as a risk signal gives you a reason to pay it down before the statement closes. Not because you're cheating the system, but because the system was going to see a snapshot and you have some control over what that snapshot looks like. If you have a credit card you never use, knowing that closing it would reduce your total available credit and spike your utilization gives you a reason to think twice before cutting it up. Again, not a trick, just understanding how the variables interact. This is what financial awareness actually looks like in practice. Not spreadsheets and budgets necessarily, but understanding the logic of the systems you're already participating in. There's also something emotionally important here. A lot of people carry a quiet shame about their credit, about past mistakes, about a hard period they went through, about numbers that feel like permanent judgments. And I want to push back on that gently. The credit system has no memory of who you were when you were 22 and overwhelmed. It has a record that carries weight for a while, but that weight does diminish over time. Negative items fall off, patterns update, models learn from new data. Your credit profile is not a character evaluation. It's a data set that changes, and you, today, have the ability to influence what gets added to that data set going forward. That's not nothing. That's actually a lot. So what does this actually look like in practice? How do you use this understanding in your real life without turning it into a full-time obsession? Let me walk through a few things that are genuinely worth paying attention to. Understand your utilization timing. Your credit utilization is typically reported to the credit bureaus based on your statement balance, not necessarily your balance at the time of payment. So if you're spending on your card throughout the month and paying it off but the statement closes when the balance is high, that's the number that gets reported. If utilization matters to you right now, maybe you're about to apply for something, paying down the balance before the statement closes rather than after can make a meaningful difference in what gets reported. Keep old accounts open if you can. If you have a credit card from years ago that you barely use, there's often a case for keeping it open, even if you only use it once every few months for a small purchase. The account contributes to the average age of your credit, and its credit limit adds to your total available credit, which helps keep overall utilization lower. Obviously, if there's an annual fee that doesn't make sense, that calculation changes. But in the absence of a fee, a dormant old card is often doing quiet good work. Request credit limit increases periodically. If you've been a consistent, responsible user of a card for 12 to 18 months, there's usually nothing to lose from asking for a credit limit increase. Some banks will let you do this without a hard inquiry, meaning it doesn't affect your credit score. Even if your limit doesn't go up, asking signals to the bank that you're engaged with the account. And if it does go up, your overall utilization improves automatically, which can help your score. Be mindful of what your bank account shows. If you're banking with the same institution where you have or are applying for credit, remember that they have more data on you than just your credit file. Keeping your account in good standing, avoiding frequent overdrafts, maintaining a reasonable average balance contributes to how the bank perceives you internally, even outside of what shows up on a credit report. When you apply for new credit, be strategic about timing. Applying for multiple credit products in a short period sends a signal to risk models. Each hard inquiry suggests you might be seeking credit out of need, which registers as a risk factor. If you're planning to apply for something significant, a car loan, a mortgage, try not to open new credit accounts in the months leading up to it. The inquiries stack up and can nudge your score down right when it matters most. Correct errors in your credit report. This one matters more than people realize. Credit reports have errors more frequently than they should. Accounts that aren't yours, incorrect payment statuses, balances that don't reflect reality. You're entitled to check your credit report for free once a year from each of the 3 major bureaus. Taking the time to actually look at it, not just your score, but the underlying data, can reveal things that are actively pulling your credit limit down that you could get corrected. None of these are dramatic life changes. They're not going to turn your finances around overnight, but they're the kind of small, steady adjustments that compound over time, and they come from understanding the system rather than just hoping it treats you well. Here's what I keep coming back to when I think about credit limits. Most of us were never taught this, not in school, not at home in most cases, not in any formal way. We figured it out through experience, which often means through mistakes, through confusion, that unsettling feeling of not quite understanding why things turned out the way they did. And I think that gap between how these systems actually work and how much most people understand about them creates a lot of unnecessary anxiety. A lot of that quiet background stress about money that so many people carry around without being able to fully articulate where it comes from. Because when a system feels opaque, it feels threatening. When you don't understand how a decision was made about your life, you fill the blank with your own worst interpretation. You assume you were found lacking. You assume the system looked at you and decided you weren't enough. But the reality is calmer than that. The system didn't decide you weren't enough. The model flagged uncertainty, or thin history, or a period of high utilization, or a recent inquiry, or any number of factors that have nothing to do with your worth as a person. And because these systems update constantly, because they're always reading new data, the story isn't finished. You're still writing data into the model every single month. Every payment you make, every balance you carry or don't carry, every account you maintain, all of it is ongoing. And that means the picture of you that banks see genuinely can be improved. Not by magic, not by any single dramatic act, just through time and consistency and making slightly better decisions than you might have made before you understood how this works. That's the part I want you to hold on to. Not a perfect credit score, not some idealized financial profile, just the knowledge that this system, which can feel so mysterious and so consequential, is actually comprehensible. It follows logic, and once you understand the logic, you're no longer just a passenger in your own financial life. You're someone who understands the road. And that, honestly, makes all the difference. If this video gave you something to think about, consider sharing it with someone who might need to hear it, not to stress them out, but to give them the same thing I hope this gave you: a clearer picture, a calmer perspective, and maybe just a little bit more confidence walking into that next financial decision. I'll see you in the next one.